There's always been a debate about whether index fund investing is better than real estate investing or vice versa, although the answer to that question is a bit complicated. Both of them have their own strengths and weaknesses, and at the end of the video, you'll be able to decide for yourself. Hello there, welcome back to my channel. I have another exciting video in store for you. But before we dive into that, if you're new here, make sure to hit that subscribe button and the notification bell so you don't miss out on any of our future videos. We release new content regularly, covering topics like personal finance, money management, and economics. Alright then, let's jump right into today's video. So, index funds are a type of mutual fund, ETF, that aims to replicate the performance of a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq Composite. These funds are designed to provide investors with a diversified and low-cost way to invest in a broad range of stocks or other assets represented by the index they track. So what are the key features of index funds? Index funds don't require you to be constantly checking on them. They follow a passive investment strategy, meaning they do not try to outperform the market or beat the index they track. Instead, they aim to match the performance of the index by holding a similar portfolio of assets in the same proportions as the index components. Index funds also offer instant diversification across a large number of companies or assets that make up the index. By holding shares in numerous companies, investors can spread their risk, reducing the impact of individual company performance on the overall investment. This is very beneficial as sometimes the markets experience shock and some companies even go down. When this happens, you'll be protected as the risk is diversified. A lot of people love them because, compared to actively managed funds, index funds typically have lower expense ratios. This is because they do not require the extensive research and analysis needed for active management. As a result, index funds tend to be more cost-efficient, allowing investors to keep more of their returns. The holdings of index funds are publicly disclosed, providing investors with full visibility into the underlying assets they own. This transparency allows investors to know exactly what they are investing in. To maintain alignment with the index funds periodically rebalance their portfolios. This involves buying or selling assets to ensure that the fund's holdings match the index's current composition. As index funds aim to replicate the performance of the index, their returns closely track the overall market performance. If the index goes up, the value of the index fund's shares will generally increase, and if the index goes down, the value of the fund's shares will decrease accordingly. Here are the types of index funds you might want to invest in. Let's start with stock index funds. These funds track equity indexes, such as the S&P 500, the Russell 2000, or the MSCI World Index. They provide exposure to a wide range of individual stocks and are suitable for investors looking to participate in the stock market's overall performance. Number 2, we have bond index funds. Bond index funds track fixed income indexes, like the Bloomberg Barclays US Aggregate Bond Index. These funds invest in a diversified portfolio of bonds, providing investors with exposure to the bond market's performance. Number 3, we have sector-specific index funds. Some index funds focus on specific sectors, such as technology, healthcare, or energy. These funds offer targeted exposure to industries that investors believe may perform well over time. Number 4 is international index funds. These funds track indexes representing non-US markets and provide investors with exposure to international equities or bonds. Now that we know more about index funds, let's look at its benefits. Index funds offer instant diversification, reducing individual company risk. Index funds give lower expense ratios, resulting in higher net returns for investors. Historically, broad market indexes have shown consistent long-term growth. Due to lower turnover, index funds can be tax-efficient compared to actively managed funds. The passive nature of index funds makes them easy to understand and manage. Overall, index funds are a popular investment option for both beginners and experienced investors seeking a low-cost and straightforward way to participate in the market's overall performance. While index fund investing offers several benefits, there are also some disadvantages and considerations that investors should be aware of. To begin with, index funds have limited upside potential. Since index funds aim to replicate the performance of a specific market index, they cannot outperform the market. While this limits the potential for higher returns, it also means that investors are protected from the risk of significantly underperforming the market. Index funds typically reinvest dividends back into the fund rather than distributing them to investors. While this can be beneficial for long-term growth, it means investors do not receive immediate cash flow from the dividends. Index funds hold a diversified portfolio of assets based on the index's composition. This means that investors have no control over the individual companies included in the fund. If there are specific companies or industries they wish to avoid or emphasize, index funds may not provide that level of customization. While index funds offer diversification, they are still subject to market downturns and fluctuations. If the entire market declines, the value of index funds will also decrease. Diversification does not guarantee protection from market losses, though it can mitigate risk compared to investing in individual stocks. Index funds invest in all the stocks in the index, including those that may be overvalued. This can be a concern during periods of market bubbles or when certain sectors experience excessive growth. If an investor chooses an index fund that focuses on a specific market sector or region, their portfolio may be heavily influenced by the performance of that sector or region. This concentration can lead to higher risk compared to a more diversified approach. Some index funds are market cap weighted, which means the largest companies in the index have a more significant impact on the fund's performance. This may lead to a concentration of assets in a few dominant companies, potentially increasing risk if those companies underperform. While index funds aim to replicate the performance of the index they track, they may not achieve a perfect match due to factors like expenses, transaction costs, and sampling methods. The difference between the index's return and the fund's return is known as a tracking error. Investing in index funds requires a long-term perspective. Trying to time the market or making frequent trades may reduce the effectiveness of this investment strategy. Investors who frequently buy and sell index funds may incur higher transaction costs. Let's now look at real estate investing so that we can compare the two. Real estate investing refers to the acquisition, ownership, management, rental, or sale of real estate properties with the primary goal of generating profit. It is a popular form of investment where individuals or companies purchase properties, such as residential homes, commercial buildings, vacant land, or multifamily units, to generate rental income, achieve capital appreciation, or both. Here are the types of real estate investing. Number 1. Residential real estate investing. This type involves purchasing properties like single-family homes, condominiums, townhouses, or duplexes, with the intention of renting them out to tenants. Residential real estate investing is typically considered less complex and more accessible for beginners. Number 2. Commercial real estate investing. Commercial properties include office buildings, retail spaces, industrial warehouses, and hotels. Investing in commercial real estate offers the potential for higher rental income and long-term leases, but it often requires a more substantial financial commitment and a deeper understanding of the market. On number 3, we have real estate development. Real estate developers purchase land or existing properties to build or renovate them for commercial or residential use. This type of investing involves more significant capital in the longer time frame, but can lead to substantial profits if successful. Number 4. Real estate crowdfunding. Crowdfunding platforms enable multiple investors to pool their funds to invest in real estate projects, such as commercial developments or residential properties. This allows investors to participate in real estate deals with smaller investment amounts. Last but not least, we have real estate investment trusts, also called REIT. A REIT is a company that owns, operates, or finances income-generating real estate. REITs allow investors to own shares of real estate without the need to directly manage properties. They are traded on stock exchanges, providing liquidity and diversification. Here are the benefits of real estate investing. Rental income from tenants can provide a steady cash flow, making real estate investing an attractive option for passive income. Real estate properties have the potential to appreciate in value over time, allowing investors to profit when they sell the property at a higher price than the initial purchase. Real estate is a tangible asset, providing a sense of security and stability compared to more volatile investment options like stocks. Real estate investing can serve as a diversification strategy, reducing overall portfolio risk by having assets in different investment classes. Real estate also has its own set of challenges, and here they are. Let's start with its high initial costs. Real estate investing often requires a substantial upfront investment, including the down payment, closing costs, and property maintenance. Real estate markets can fluctuate, impacting property values and rental demand. Local economic factors and housing market conditions must be carefully considered. Real estate investments can be less liquid compared to publicly traded assets like stocks. Selling a property may take time, and transaction costs can be significant. Real estate investing entails legal and regulatory obligations, such as property taxes, local zoning laws, and landlord-tenant regulations. Active real estate investing involves property management responsibilities, such as finding tenants, handling maintenance, and dealing with tenant issues. Real estate investing can be a rewarding and lucrative strategy when approached with proper research, due diligence, and a long-term outlook. Whether investing directly in properties or through REITs and crowdfunding platforms, it is essential to align investments with individual financial goals, risk tolerance, and time horizon. Seeking guidance from experienced real estate professionals or financial advisors can provide valuable insights and help make informed investment decisions. Also, despite the disadvantages, index fund investing remains a popular and prudent choice for many investors due to its simplicity, low costs, and potential for long-term growth. However, it's essential to consider individual financial goals, risk tolerance, and investment preferences before making any investment decisions. A well-balanced investment portfolio may combine index funds with other investment vehicles to create a diversified and tailored approach that aligns with one's specific financial objectives. Additionally, consulting with a financial advisor can provide valuable guidance in constructing an investment strategy that best suits individual circumstances. So which one of the two would you prefer? Personally, I love real estate, especially investing through REITs. Please tell me what you'd prefer in the comments down below. That's all I got for you today. Thanks for watching this far. I hope you enjoyed the video. Don't forget to hit that like button if you find this video helpful, and if you have any questions or suggestions, also leave them in the comments section below. We love hearing from you. Goodbye.